The latest Canadian job report's out now, and it paints a very interesting picture of Canada's economy. On one hand, we're seeing job growth, and yet unemployment is creeping higher. So what is going on here? I want to break that down, find out what these numbers really mean. So let's start off with what the data says. First off, Canada added 51,000 jobs in November. That's a 0.2% bump there. Full-time positions, they led the way with a gain of 54,000 jobs, while part-time employment dipped slightly. Now, on the face of it, that would sound like pretty good news. We want to see those full-time positions, but there's a twist here. The unemployment rate, it actually climbed by 0.3 percentage points, came in at 6.8%. That's now the highest since January 2017, if we strip out those pandemic years. A reasonable question here to ask is, why is this happening? There are more Canadians entering the job market, actively looking for work, and that pushes up the unemployment rate. In fact, the labor force participation rate, it ticked up to 65.1%, and that offset some recent declines. Now, if we zoom in on who's gaining and who's losing jobs, let's have a look at some winners. First off, core-aged men. So this is the contingent 25 to 54 years of age, saw a big boost, 45,000 new jobs that pushed their employment rate up to 86.5%. Now, certain industries also stood out. We saw wholesale and retail trade, 39,000 jobs added there. Construction saw a gain of 18,000 jobs. Professional, scientific, and technical services added 17,000 jobs as well. Now, when we flip over and look at the losing side of this, it flips over to women who are aged 55 to 64. They weren't as fortunate. They lost 20,000 jobs in the period. That drops their unemployment rate down to 58.6%. Now, manufacturing also took a hit, 29,000 jobs lost there, especially in Ontario. Transportation and warehousing was down, 19,000 jobs. This is likely tied to ongoing labor disputes. Now, if we look at this from a regional perspective, Alberta, strong month, gained 24,000 jobs. Quebec was up 22,000 jobs. Ontario, though, stagnated and saw its unemployment rate rise to 7.6%. That's the highest since 2014 now, again, if we cut out those pandemic years. So the big question here is, what does this mean for policy? Because we've got the Bank of Canada coming up with their next decision on Wednesday. So when we see unemployment edging up, what effect or what influence will this have on the next decision? Well, on one hand here, we see the rising job numbers, and that signals that there is some strength in the economy. But when we look at it a little from a different perspective, we have higher unemployment, and that might make it look like conditions are actually softening a little bit. So the bank, when it makes its decision this coming Wednesday, it'll also be looking at wages, and the average hourly pay rose 4.1% year over year. So let's just take a step back for a moment here. When we look at these numbers, it says to me that Canada's labor market is at a crossroads here. There is no doubt that the job creation is encouraging. That's a good thing. But the steady rise of unemployment since April 2023, now up 1.7 percentage points, and that raises questions about how sustainable the growth is. In other words, are we entering a period of economic uncertainty right now, or are what we're seeing this last report just sort of a blip as the market overall recalibrates? Also, I did notice the youth unemployment rate. That jumped to 13.9%, up more than 2 percentage points from last year. And look at that trend since we came out of the pandemic years. What does this say about young workers trying to get into the job market? What is your employment story these days? Are you all good, or are you part of that rising employment number? Drop a comment below. Imagine for a moment that you are planning your future and you're balancing the need for growth with a desire for some steady cash flow. Maybe you're thinking about retiring early or funding your child's education. Well, the BMO Balanced ETF could be the solution that you have been looking for. It is a carefully crafted mix of global equity and fixed income ETFs from BMO Global Asset Management. This is designed to help you grow your wealth while at the same time managing risks. The fund automatically rebalances every quarter to keep your investment strategy on track, even when the markets shift. You're not just investing in a portfolio, you're investing in peace of mind, knowing that your money is managed by a name that you can trust. You can explore how the BMO Balanced ETF can fit into your life, help you reach your goals. Visit bmoetfs.com today to learn more. As I mentioned in the previous segment there, the Bank of Canada is set to announce another interest rate cut on Wednesday this week. Most analysts right now are expecting a 50 basis point reduction, and that would take the rate from 3.75 today down to 3.25%. Inflation today is in the central bank's target range, but we've seen weak GDP growth, rising unemployment, which is now at 6.8%, and this is bringing calls for some aggressive action. Now, Nathan Jansen, he is the assistant chief economist at RBC, and he had this to say about the bigger picture. He says, Essentially, it looks like inflation is back under control, the economy is much softer, and the trend has been continuing to soften, and yet we still have a restrictive level of interest rates with the overnight rate still historically high. That said, though, we can't just forget about the fact that we are weighing these risks with the Canadian dollar, which has been weakening now at a 4-year low of about 70.8 cents USD. Another expert who follows this is Benjamin Rice, as he is the managing director of Canadian rates at the Bank of Montreal, and he's expecting a 50 basis point cut as well based on the latest job numbers, but he doesn't necessarily agree with this. He says, while the move in the currency over the past number of months has been relatively orderly, you run a risk of the currency really weakening at a much faster pace. That makes policymakers uncomfortable. He goes on to say, as the currency weakens, especially in the winter months, it will be detrimental to Canadians in general who have to pay higher prices for food and gasoline and other things that are imported. And that's not a positive for Canadian living standards. Now, meanwhile, we always seem to have more than one train of thought here, and not everyone is on the same page. Royce Mendez, he is the head of macro strategy at Desjardins, and he's calling for a 25 basis point cut, and he's arguing that the sharp rise in unemployment last month was more because of the rise in participation and not in layoffs. And he says the data is lukewarm, but not bad. Specifically, he says, it's hardly convincing evidence that you need to absolutely cut rates by another 50. And just to put that in context, 2 consecutive 50 basis point cuts, whether neither the Canadian nor the US economy is in free fall, would be unprecedented. So here we are, we have mixed signals, we have mounting risks. The Bank of Canada is facing a pretty tough choice, I would say, in balancing the economic stimulus and at the same time avoiding any potential long-term fallout. I have a couple of bank-related stories to finish things off with today. If you're wondering how the big banks fared last year, well, bonuses might be a clue. On average, performance-based payouts jumped 12%, added up to about $23.75 billion across the board. You look at some banks like CIBC, they really opened the wallet there. They had a 19% increase, rewarding strong profits. While at Scotiabank, the other end of the spectrum, the needle barely moved. We saw a 4% hike there. Now, what stands out to me is really how uneven the results are across the industry here. Some teams absolutely crushed it, like the fixed income desks, while equity traders, it looks like they struggled a little bit. When we look at Royal Bank and National Bank, they both rewarded their teams 16% and 14% bonuses respectively. That is thanks to strong capital market performance there. Then we look at TD, which has been on a wild ride for a lot of different reasons recently, but they still managed a 10% increase in bonuses. That's pretty solid considering the challenge they've been going through. When we convert that into real dollars, that's $4.48 billion. So not bad when you add that all up. Now, on a different note here, still staying with the banking sector though, Canadian Western Bank, they were supposed to report their earnings last week. They are now in the spotlight for the wrong reasons here. They had to push back their earnings release because of a legal claim that's tied to their Maxima Financial division. The claim itself, it involves $18 million in damages, and it alleges unethical behavior by a sales agent. Now, the bank says that this shouldn't affect their financials or their pending $5 billion sale to National Bank, but as you can see, the market is still trying to figure out exactly what's going on. On the news, shares dropped over 5% on Friday, but they're showing a pretty nice recovery today. Earnings for Canadian Western Bank are now expected by mid-December. I'll be watching to see how this all plays out. We're a third of the way through December, but the news isn't stopping to come in, so I will be back here on Wednesday with my next update. As always, thank you for watching, and we'll see you in the next video.